Traders, is this US dollar bounce going to continue ahead of a critical week? We have the FOMC rate decision. All eyes on Jerome Powell, guys. Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So, traders, back with another fundamental update. The US dollar does continue its path to the upside, and now we're at the second consecutive week in the green. And for me, guys, if I just ignore the fundamentals for the moment, which we're going to get onto, if we strip out all of that and just understand that the dollar's been in a massive downward trajectory since January, okay, since the commence of this year. And, markets don't move in straight lines. I have to make that extremely, extremely clear. Obviously, in these periods, when we have sustained moves in one direction, we're going to have periods of pullback. We're going to have periods of consolidation and profit taking. Okay, that's normal. Now, it's not to say that this dollar bounce is now the stage or it's lay the foundation for a massive recovery. No, I would still take that with a pinch of salt. Yes, we have seen some calming concerns of recession fears, which we've been talking about, which is part of the reason why the dollar was heading to the downside. Yes, we have seen some calming of concerns around the tariffs because remember, we had the heightened trade war. Trump was going after everybody, and then US and China were hitting each other back and forth. It's like tennis, boom, 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 ping pong, hitting each other back and forth with tariffs. But obviously, we've seen those calming down in terms of the actions being taken. And now, obviously, both US and China, there's been a lot of chatter, but both of them seem keen to want to engage in dialogue, but no official negotiations have come underway. So that's why I just say, take it with a pinch of salt. For me at the moment, this is purely sort of a technical bounce. Yes, there have been some calming concerns, but we haven't seen anything drastic to necessarily shift this us out of this macro driven structure, which is to the downside. Now, look at my screen here. Okay, we had, of course, a lot of the focus was on non-farm payrolls when my computer decides to load. There we go. If we just bring up the calendar for last week, okay, the focus was all eyes was on the NFP number from the United States, where we beat expectations. They're coming in at 177,000. But for me, that was offset by the previous being revised lower to 185K from 228. Okay. And when you look, as I say, we are generally seeing a cooling. We've seen quite consecutively revisions to the downside. There's definitely obviously a slowing down in the labor market. The average earnings, which is important, this cooling down to 0.2%. You know why it's important. Don't let me remind you, all right, but I'm going to remind you. It's like ingrained in that head so you can start thinking like a macro analyst and executing still like a trader. But remember, when wages are coming down, it's disinflationary. Why? Because people essentially getting paid less, right? And if people are getting paid less, generally speaking, then we're not going to be getting less spending. Okay. If people are getting paid less, there's going to be less spending, less stimulating the economy. And then, of course, if there's less stimulating in the economy, then price of goods and services is going to come down. Okay. Disinflationary, which means what for the FOMC? If inflation's coming down, it gets them closer towards rate cuts. Okay. They only want to cut rates if inflation is coming down. If there's signs that it's remaining sticky, they're going to be hesitant to want to cut rates. Because remember, when we're cutting rates, we're lowering people's borrowing costs, either their outstanding loans, their credit cards, their mortgages, all of that. And then if we're lowering the borrowing costs in a time where inflation's still sticky, people are going to go out and spend money. And then, of course, that's another problem. So the fact that this is coming down, that's disinflationary, is good. It moves us potentially towards closer rate cuts from the FOMC, albeit they're remaining pat at the moment. We're going to get onto that. And the unemployment rate remains steady at 4.2%. But earlier in the week, we had poor GDP. Okay, it's a contraction of 0.03%. We're not surprised. Remember, I said in that previous video, I am very much in favor of seeing lower growth for the US. Okay, and then core PCE, this is the Fed's preferred measurement of inflation. The headline came down to 0.0% there. However, the previous was revised up from 0.4 to 0.5. So offset it a little bit there with that previous revision. So either way, inflation's still a little bit sticky in the United States. Now, of course, all eyes are on this Federal Reserve rate decision. Now, for me, guys, to be honest with you, I don't see any change. Okay, I don't see any change in terms of their stance. Sorry, I'm just bringing up CME here for a moment. Okay, just so you can see market pricing in at right now. Now, obviously, for this decision in May, it's only a 2.8% probability that these guys are going to start cutting this month. June is where all the volatility is at. We're expecting 34.5% probability, 34.9%, excuse me. I was going to say around 35%. So 34.9% probability that they're going to cut. 65.1%, no change. Okay. This is where all the volatility is at, and this is what market's going to be focused on in terms of Jerome Powell. Are we heading for is he going to position markets for a June cut? In my opinion, I think he's just going to have a similar tone to the last decision, all right, where he just notes, yes, there are risks potentially to tariffs. It's clouding the outlook for inflation, where at the end of the day, they want to see how it unfolds. And if there's any agreements being made that could obviously be good, because remember these tariffs are inflationary. So I think that's the most likely scenario. And I think if they just stand pat on that, because there are obviously growing expectations or desires for to FMC to get closer towards rate cuts. But if they are not any closer and they're still holding steady, then that will support dollar in my opinion. Now, if we look at the dollar here, obviously as I said to you guys before, structurally we have been to the downside, right? We've been printing lower highs, lower lows. You can see the clean structure as well on the daily. Look at that, it's beautiful. So that's why I just said take this pullback that we're seeing at the moment with a pinch of salt, because we are ultimately still respecting this overall higher time frame structure. Okay, now given that bounce at 98, as I noted a couple of weeks ago, which we were targeting, you can see where the next major weekly resistance is. It's going to be taking us into 150. So if we tie in fundamentals for a moment, if we do get that FOMC just keeping echoing a similar tone to the last decision, which I think is the most likely outcome for the dollar, that, as I say, could provide some modest strength or at least keep the dollar resilient in this current pullback stage as they keep that wait and see stance. Okay, wait and see until what happens with the tariffs. So with the dollar, I'd still say we're going to have a room to push to the upside, at least into this go and challenge this 150 area. 101 tops, in my opinion. The reason I say that quite aggressively is because the monthly candlestick's so freaking bearish. It's not to say that we couldn't go and form a green candle here, but it seems unlikely. The odds are stacked against it. The grain is still there in favor of bearish macros right now. As I've just explained, I said to you guys in that previous video, we need a massive breakthrough for the dollar to break out here. And that breakthrough really is only going to come, in my opinion, now with tariffs. Okay, we need a breakthrough in the tariffs. If anything suggests that these tariffs are stalling again and no progress is being made, or US and China decide to walk away from initial negotiations, bear in mind it's a very long road ahead. We've got the whole of 2025 with this trade war, by the way, guys. It's not going to end anytime soon. So I just still see the risk tilted to the downside this month, okay, in the month of May. We may still have room for a pullback. Perhaps we see something like this. We start forming, a potential bearish flag, like we have these channels here before we break out. And I'll just be keeping an eye on this week, subject to, at some point, maybe the following week or the week after, but at some point in May, I would like to see a resumption to the downside. And I think that catalyst, and look at that, it would respect structure. That's just obviously my view. The catalyst for that, I think, will be a breakdown of talks or just backtracking both US and China on tariffs. So really, that's the main focus for the week for the dollar FOMC rate decision. There isn't anything else major dollar related. Oh yeah, okay, excuse me. Let's keep an eye on ISM service PMI. US is more so based services, so that's a big one. It's expected to remain in growth territory, which is 50.2. Now, obviously, I said for now, the calming of concerns around recession or the recession fears have calmed for now. But if this slips below 50, guys, watch the dollar will face some selling pressure initially this week. Okay. And it could even finish the week in the red, as this really setting sentiment. So that needs to remain above 50, really, guys, and then we'll get a relief. Because last week, if you look, this is how sensitive the markets are, and it's funny. They're so sensitive to dollar-related data. When you look at last week's, sorry, and I'm jumping thing to thing, this is like organized chaos. This is chaos in my head, all right? But stay with me, you get it. ISM manufacturing PMI. The US isn't a massive manufacturer, but this data came in at 48.7. Look, this is really important to know. I want you to stay with me. It was higher than the previous expected at 48.0, right? Bear in mind, we're in contractionary territory. Remember, anything below 50 is contraction. The previous number was 49. So we've cooled down from the previous, but markets got overexcited, right? On Thursday at 3 p.m., markets got excited just because we were higher than the expectation. But we're still lower than the previous, and we're still in freaking deep contractionary territory. But this is how sensitive markets is like, just like on edge, like, are we going to get a recession? Like they're freaking out. So they just had a relief rally there. If you look there at 3 p.m., I just want to show you 3 p.m. on Thursday, bam, that's on the ISM manufacturing. But services is very, very, very important. And obviously that can set the tone heading into obviously FOMC on Wednesday. Just quickly as well, guys, just if you look at some of the dollar related as well on the monthlies, right? Euro dollar still bullish here. Remember, euro's been seen as a bit of a safe haven outside of the dollar when all these tariff shenanigans, but it still remains bullish there, obviously subject to pullbacks near term. I'm going to jump over to Aussie a moment because Aussie's obviously performing quite well. And I just want to note Aussie because last week, obviously, we've seen inflation remain sticky in Australia, and which is probably why the RBA are going to be on hold again. RBA have been on hold for the last couple of months, probably going to be on hold again. I know markets are looking for rate cut this month, but inflation still remains sticky. And this is why when you look at Aussie dollar, just look on a naked chart a moment, it was look, it closed in the green. Euro closed in the red. GP closed in the red. Most dollar pairs closed in the red, but Aussie held ground because of that sticky inflation. It pushed back. It adjusted some of the rate cut pricing that markets are pricing in for the month of May for the RBA. So, but really, as I say, just reinforcing what I noted with the dollar, the monthly candlesticks, they're still bullish for a lot of these dollar related. Obviously, G is at a bit of a top here, which we'll talk about in a moment with Bank of England. But yeah, it looks like dollar's still vulnerable. As I say, we need something drastic to shift things. Volatility also expected for GBP because we do have the Bank of England rate session where they are expected is pretty much 100% pricing, is 99% something pricing that these guys are going to be cutting by 25 basis points. Obviously, been on hold for, has it been 2 months now? Yeah, 1, 2, they've been on hold for 2 months. And they're expected to cut again, resume their rate cutting cycle. It's supposed to be unanimous. Market expecting all members calling for a rate cut. I just want to show you something. Let's just bring up GBP, CPI. Let's look at UK CPI. UK CPI on a year-on-year annualized level, which is important. Look, it came down to 2.6%, but it's still a bit sticky. All right. Remember, these guys want inflation down at around the 2% mark. So we're still quite far away from from the Bank of England's target. And then when you look here as well, I just want to bring up UK GDP. UK GDP, remember that last reading we saw a surprise to the upside of 0.5% in terms of growth. I've got a good memory, 0.5%. It's much better than the forecast, much higher than previous. Just look at, I just want to bring up, see what retail spending's like. I can't remember, but I just want to bring it up here as well. Look at consumer spending. Consumer spending up as well, 0.4%. And then lastly, let's just look at UK labour market as well. See, just building a picture a moment, and I'm going to tell you why. I want to go to this day because on this day also, it's the average earnings I'm interested in. 5.6%, which remained, well, the previous was revised lower from 5.8 to 5.6. So that is cooling a little bit, but it still remains quite healthy when you look at wages. They've still, look how much they've jumped up and it's still at 5.6%. So the reason I'm noting all this is because, look, inflation's still away from the Bank of England's target. Okay. There's still inflationary signs where wages still relatively high. Year on year, CPI is high. Inflation remains sticky. Retail sales is still healthy. GDP is still okay. So if they do cut rates, I think it's going to be quite a neutral, if not potentially a hawkish cut, where they don't leave the door open for more. For now, they may just observe this rate cut and not commit to further cuts, which would obviously be. We may see on the initial cut, we may see a little bit of weakness initially in GDP, but then strength. Yeah, I just that's what I believe. But obviously, GU tells a different story this week. Okay, with that dollar bounce. When you look, we've got a bit of a double top here. Okay, at 134. Obviously, their outlook, by the way, their outlook could still be negative, in terms of growth forecast, because they were a couple of months ago. Remember, they were a couple of months ago. They downgraded their growth forecast. They saw sticky inflation. They basically said the UK is going to go through stagflation scenario and consumers are going to really feel the squeeze. So they were quite negative. I don't. The outlook hasn't necessarily. It has improved a little bit, but this is just near term. So it'd be interesting to hear it from them. Okay, and obviously the UK aren't really involved too much with tariffs as exposed to some other economies. But when you look at this technically, we have hit a bit of a hit of a top here. Not necessarily that we've hit a double top, because if we call this really a double top, like a textbook double top, we could be coming all the way back down to this neckline here at 21.55. And I think that's very unlikely. As I said, unless something drastic happens with the dollar, I don't see that as very likely. Okay, so this looks a little bit vulnerable here. We've formed a couple of reversal candlesticks. Okay, obviously we've been largely structured to the upside when you look at that aggressively. Bar this little bit of volatility here, but it's been very aggressive to the north. And you can see we're sort of in consolidation mode, subject to potentially topping out. Now, if we look technically, we are at a bit of key support, trying to protect this 33 towards sort of 32.50 area. Okay, you can just sort of see that support is holding ground there. Look, resistance, resistance, support, support. So this is where we're at right now. Price action, a little bit in a consolidation mode, but we've got a potential bearish pennant here, which you might want to break out of and just resume to the south. Now, just going back to the weekly moment, your 132 is the next major area of support. Now, keep in mind the Bank of England isn't until Thursday, so there is some selling that could come into play ahead of the Bank of England decision. But I would say downside targets are capped there at 32, in my opinion. I mean, because obviously if this zone gives way, it's going to be quite a drastic pullback, okay, down to towards sort of 30.50 area. And then obviously you got your 30 double O. All right. So keep an eye on that. Yes, it does look vulnerable because of this dollar rebound. But I'm going to obviously at the end of the day, I don't have a crystal ball, but it'll be interesting to see what the Bank of England say because this will help shape up direction near term with GP, see if they are sort of pushing back on further rate cut bets. But I'm excited for volatility, finger on the pulse, always ready to digest that statement, compare it how it compares to the last statement, and then position accordingly. Look at opportunities. It's not just for GBP versus the dollar. You're looking at opportunities GP versus CAD. You look at GP Aussie, GP NZD. GJ, there's opportunities outside of GBP versus dollar, just so you know, and it's conducting that analysis on an economic level, on a monetary policy level, and seeing if there are divergences. Guys, there's opportunities there. Just gotta use your macro head. New Zealand dollar. We do have some volatility then for Kiwi. Why? Because we've got labour market figures. And why is this important? Because, the RBNZ have been a very dovish central bank. They've cut rates quite aggressively in comparison to other major central banks. Obviously, New Zealand's very sensitive right now to the tariffs, as an impact of whatever happens with China. Obviously, China potentially slowing down as an economy. Not potentially, they have been. We're seeing price of goods services been falling, deflation there in China. And of course, they'll get hit if these Chinese tariffs, these US tariffs on China remain in play. It's going to be crippling for the Chinese economy. And of course, that's going to be crippling for New Zealand because China is their biggest two-way trading partner. China purchased a lot of goods from New Zealand. They're reliant on Chinese business. And so obviously New Zealand obviously purchases as well from China. So there's a lot of a lot of things to consider when trading New Zealand dollar. Now, right now, this week, we're going to be focusing on labour market figures. They're expected to worsen in terms of the actual unemployment rate. Unemployment is expected to jump up 5.3% from 5.1. I think that's quite a pessimistic expectation. Okay, seeing such a jump there. Employment change expected to remain steady. We're still supposed to see decent employment change there, 0.1% growth in comparison to the previous quarter of minus 0.1%. I think those numbers in terms of the unemployment rate is a little bit harsh. When you look at NZD as well, in terms of data, the other week, remember a couple of weeks ago, we had CPI inflation sort of arguably sticky there in a quarter and quarter. So this labour market figures, if they're not as bad, then it's going to push back some of the RBNZ rate cut pricing. Now, obviously, NZD versus dollar did actually finish in the red with that dollar pullback. Remember, as I said, Aussie dollar was the one that outperformed. But despite this sort of pullback that we saw there, it's not that bearish, really. Okay, it's not that bearish. We didn't see like a bearish engulfing of this candlestick. I think on a daily, this is what I was looking at. We do have a bit of consolidation here, subject to a potential breakout to the upside. Maybe we're forming a nice bull flag here. Let's see. Obviously, this upside pressure will be very much dependent on those labour market figures. But then obviously we do have the FOMC rates issue, so it's a little bit of a tricky one to trade. But I think if we do get decent labour market figures here on Tuesday, we could initially get a breakout here, obviously ahead of FOMC. We could at least go and challenge those highs into sort of 60 double O, into sort of, 60.20. This is the highs there of last month. It does look like a big potential freaking pull flag. And look, that would fit in with the monthly views, the monthly views that I was talking about with the dollar, where it does remain vulnerable. So we could see NZD holding ground there and breaking out, but we do need to see decent labour market figures there from New Zealand. And last but not least, Canadian dollar. We do have key labour market data also from Canada. Okay. Canada's labour market data is expected to remain steady. Decent employment change expected this time round after the contraction of 32.6 thousand jobs being removed from the economy. 24.5 thousand expected to be added, with the unemployment rate expected to remain steady at 6.7%. Now, CAD data has been a hit and miss. Like when you look at last week, we had a contraction in GDP again at minus 0.2%. Okay. I think the Canadian economy is a little bit on and off, more so off than on. Obviously, they avoided those fat ass tariffs from Trump. For now, you never know what might happen. Obviously, Trump did threaten again. So let's keep an eye on these labor market figures. But when you look at Looney, obviously a very, very, sorry, let's go on naked chart. There's me doing a lot of demonstrations on there. But when you go on a naked chart, extremely bearish candlestick there. We're in a bearish, trend at the moment, especially from this monthly in Feb. We're at key monthly support. You can see it there around 3800, guys. I think I mentioned this in the previous video, and we haven't moved since then. On the weekly, you can just sort of see trying to grind down this sort of key resistance around 3800. It's interesting because I like to look at a daily where we're potentially forming, just a bearish channel here, subject to eventually breaking out of this wedge, sorry, more so a flag. And I would be interested in this once we clear these lows. I'll be interested in these shorts. As I said to you guys in that previous video, it'd just be a case of working zone to zone, but an element of caution, of course, with the FOMC decision this week. Okay, but as I said, I just don't see this dollar rally being sustainable, in my opinion. Either way, guys, we're filled with volatility and events and market narratives and all sorts. So important to have your finger on the pulse, baby. We're blessed. We're blessed as traders. Other than that, have an amazing end and, of course, a blessed week. And I'll catch you on the next video.